All right, so first, I know it's been a long day for everybody, so we appreciate you sticking with us. And I know we've been a bit delayed as Tim was sharing words of wisdom on the main stage. But really wanted to get this panel of experts together to give you an idea of how we started our crypto funds, to give yourself a background on my experience. Run BlockTrade Investments, the only SEC and FINRA compliant fund in the world currently. Started that 2 years ago and is still the only one today. But let's kind of dive right in with the experts here. And the first question we want to ask is, what are the key pieces of infrastructure that you need in place to develop a successful crypto fund, or in your experience, what steps have you taken?
Hey guys, this is George from HGR Advisors, by the way. And I think that's a great question, right? I think you hear a lot of people say there's like hundreds and hundreds of crypto funds out there, and the reality is most of them aren't set up the right way, and there's just kind of these mom's basement kind of fly-by-night exchanges, funds rather. And so I think at a high level, I'd probably defer to like my CFO for most of the granular details. But I think you want to set up your fund entities sort of in a regulation compliant way and in a tax efficient way. Things that go into that could be kind of geographic domicile, any licenses you need, any exemptions you need from the governing bodies if you're here in the U.S. Beyond that, I would say like you have like a whole host of advisors you have to think about as well, from kind of legal counsel, which is very important. You shouldn't kind of cheap out on legal counsel. They're expensive, but you got to pay for them. To your fund auditors, to like the fund administrator, to even like OTC providers, over-the-counter providers, exchange accounts, and stuff like that. So if people have anything to add, maybe I'll just leave it at that. It's kind of the advisors, the entity structure, and also the other thing we think about at HGR is just security and custody of assets. Like how do we set that up in the back end? So yeah, we spend a lot of time thinking about that.
Now, I guess for the rest of us, we all operate potentially in different jurisdictions. Can you shed some light on the jurisdiction that you operate in, and if there's been anything unique from that standpoint? Because I think for a lot of people, starting crypto funds, it's not a one-size-fits-all solution. It's not the same way in the United States as it would be if you set up one in Estonia. So kind of shed some light for the audience on that aspect.
Yeah, so our fund is actually set up as a hedge fund, so it's a traditional kind of master feeder structure where, because we're taking a lot of foreign money, most of our LPs are foreign based, and so we invest out of a Cayman master fund, right? But we have these feeder vehicles that are optimized for largely tax domiciling, depending on where the LPs come in. And so, like, yes, a lot of the principals are here in the U.S., and so we also have kind of a management company in Delaware. We have to be filing with, the right regulatory bodies here. And because we're a smaller fund, I think if you're under like 150 AUM or you can file for certain exemptions. So because the cost of compliance is very, very expensive, right? Yes. So for a smaller fund, there's a lot of different ways you can navigate around that, get exceptions. You can kind of cap your investors. Like for us, for instance, we might have a cap of like 100 U.S. investors, and anything beyond that, we would have to, we can't operate under exemption anymore. So there are trade-offs, I would say, and a lot of it's like more nuanced, and you could go into kind of the details, but you'd spend hours and hours talking about that, right?
Well, I'd love to hear from the rest of the panel as well.
Well, I live in an offshore jurisdiction, and think it's in Nevis, and very specifically, Nevis is known globally as an international financial center. So one of the key regulatory requirements really is looking at where it is you're domiciling your fund. Like he mentioned, he's in Caymans, and it's really key looking at the infrastructure that exists to support that. So for instance, in Nevis, one of the key things that Nevis will have over the Caymans, for instance, is the fact that it has an additional layer of asset protection. For the most part, they do not disclose members of the LLC, and you can actually set up a fund using many different structures. It really dependent on you. So Nevis doesn't have like a very specific requirement that it has to be an LP. It could be a company, it could be even structured as an LLC, or it could just be an LLP and whatever. So for the most part, with Nevis, you have an additional layer of asset protection, as I mentioned before, because they do not disclose who the members are of your LLC, or they don't disclose that. So while you have a local regulator that you register with, they still keep your information safe. Secondly, if someone were to bring a case against you, they're going to have to go through Nevis. So Nevis does not recognize any other jurisdiction as apart from Nevis, and in order for that case to go through, they probably have to spend like maybe $200,000 just for it to be heard. So there have been many cases where persons have tried several times to try and bring cases against Nevis. They'll probably have them tried here in the U.S., but still, they can't bring a judgment against you unless it's tried in Nevis. So those are some of the nuances. So it's good for, if you're looking for capital preservation and looking also to protect your fund, that too. But just because you are offshore, it does not mean you have to disregard the other laws. So if you are, for example, a U.S. Fund manager, you have to also know, what the cap is in terms of what you can do, how much assets under management you can have before you register with the SEC. The only difference is you do have a bit more of, should I say, freedom to manage and run your fund, and what's the other word? Yeah, freedom to manage and run your fund. And it's also a really solid jurisdiction because their infrastructure will have then a number of service providers you can tap into to support you. So one of the good things for us at Beyond Capital Markets is we have actually started supporting persons who are in the impact space, because there need to be new managers, new advisors and new type of fund managers within the impact space. And for us, crypto fund managers can literally start looking at that particular niche of impact, because we see impact covering a large area of asset classes. So it's not just about social good. Impact covers, for example, renewable assets. It's really a huge opportunity. But then there's a big gap. There's a big gap in the impact space and impact investing because there aren't enough, or there isn't a proper infrastructure to support that. So we're building out the entire infrastructure. Part of that would include providing solutions to support fund managers, which include back office solutions. And with crypto, you have their whole wallet infrastructure. Of course, we're following the regulatory guidelines within Nevis, so that means we follow normal KYC, AML, CFT procedures. Also providing crypto fund managers, trading desk, automated trading bots as well. And then most importantly, through our Beyond Academy, we're providing the critical training to have people get there. Especially, we recognize when it comes to impact, I've spoken to a lot of investors, they still don't understand impact and how impact can be actually measured and assessed and how important that is. And more and more so now, in every single portfolio, there are requirements now for you to measure ESG measures and so on. So we found a very specific niche in supporting the development of crypto fund managers.
Well, that's a very good point. And Dean, if you should shed some light as well.
Yeah, that was very comprehensive. Yeah, thanks I learned a lot there. So, I have a Delaware entity. It's a master feeder hedge fund structure, and I set up the fund while I was honestly I was broke, basically. I wanted to do it as cheap as possible. I hadn't even graduated with my undergrad, and so I just wanted to do a Reg D offering for basically my parents' rich friends who wanted to invest. And also going to Stanford, like a lot of my friends have rich parents too. So That helps. So anyway, so I did a Reg D offering, securities exemption, under 100 million AUM, up to 99 accredited investors. And that's a process that cost about $25,000 all told. So if
And Dean, I don't mean to interrupt you, but that's on the very cheap end if you're an American, just so you know.
Yeah. So yeah, I had a co-founder actually whose dad started a big fund, and he was not that much help. I thought it was going to be a lot more help. My co-founder was like a free rider who I had to dump later on. But initially, his dad actually like referred this really cheap lawyer in Florida, so I can refer that guy if anyone wants to. He's really good. Also does like BVI feeders. So anyway, did that. You need a bank account. When I set up early last year, I went through Signature, and so they require like $1 million in cash or $7,500 a month. And so yeah, either way. I'm not sure if they're actually taking new crypto fund clients. They might be, but.
Well, and Dean, quick question just on that aspect. What allowed you to settle on them versus going to commercial institutions or investment institutions like so many probably think is the conventional or the best route?
Yeah, I mean, honestly, a lot of those conventional institutions don't want to take crypto funds. So you have to go for a little more of the experimental or digitally focused, more front of the market banks. And Signature is an internet kind of banking institution in New York, and there's a few of those. Silicon Valley Bank is probably the most well-known locally. And honestly, they were just referred to me from my lawyer, so I just took his advice. Also, the admins, the admins can get kind of expensive because there's a lot of complex new ways of reporting that they have to deal with, a lot of risks they have to take on. To be crypto fund administrators. So my first admins was Tower Fund admins, and they were awful, actually. They were really bad. So I would not recommend going with them. And then I had, my auditors were Spicer Jaffrey's, or however you pronounce that. And they were pretty good, actually. So yeah, you need an auditor, admin, legal counsel, and yeah, 25, 30,000, you can get it up and running. So.
We appreciate that insight, Dean. And Sam, I know it's taken a long time to get the mic over here. We'd love to get your input as well.
Okay. So, hi, thank you, by the way. So, just want to clarify a little bit. You're asking about crypto fund, right? Not in general VC fund that's
yes,
in equity.
VC fund is going to be a completely different route. It's going to be crypto funds only for this panel. Sorry for anybody who wants more.
Yeah, okay, just a quick introduction. I'm Samson Lee, Sam, you can call me. I'm based in Hong Kong. We are a boutique investment bank for the crypto world. So we help company construct and put the ICO together, do the fundraising, private sale, public sale, also being sponsor, help them to list the token, listing services, marketing, investor relationship, and all that. We also run 2 crypto funds out of Singapore. The fund is registered as Cayman Island, but we market it, in Singapore with an MLS license.
There seems to be a theme here.
Yeah. I would say the most challenging is to put a proper fund fact sheet together. Right? This might be something taken for granted for people just investing in regular fund. Right? Every fund have a fund fact sheet, but for the crypto fund, to really make a complete fund fact sheet with all the custodian, the bank, or the auditor, is not so easy. The bank part you bring out, a lot of the bank don't open up bank accounts. So we are fortunate we can find a solution, everything in Singapore. But of course, there's a long filing process, auditing and all that. But I think it's worth it. But what's interesting is when we try to market the fund to Europe, right? In Hong Kong, Asia, Cayman Island fund is all good. But for the European market, what I find out is people in general is not that comfortable with Cayman Island fund. So now we have to try to set up a fund in Malta, just to get to the European customer. Yeah.
Well, we appreciate that insight, and ultimately, just to share a little bit of my experience going through the SEC, going through FINRA, expect 6 figures to set up a fund. At the end of the day, SEC attorneys are not going to come cheaper than $400 an hour that are going to have any connection to the SEC or FINRA and allow you to be reputable. Ultimately, also be aware of organizations that claim they are compliant. Everything is hidden in PPMs and in subscription agreements. So read them. They're the most important thing that you could possibly put together, and they are what determine the individuals that will ultimately be able to participate in your fund effectively. And I would like to kind of expand on that a little bit more on how you targeted your initial investors. And with us being some of the first private equity funds or hedge funds, whatever you'd like to call yourselves from an establishment standpoint, what was the difficulty you ran into with initiating those first talks and completing those first investments with new investors?
Yeah, I can go ahead. So, you know, you have to really pick your LP profile in terms of how to effectively market the fund. I mean, so there's, you know, legal issues around how you can market the fund, first of all, you should be aware of. Like, you know, there's a prior relationship notion for a lot of, you know, fund classifications. And so, you know, it helps to have a rich network, honestly. But honestly, like, my initial investors were mostly, you know, legacy investors who maybe were in private equity or in, you know, public equities or whatever, who had kind of heard about this whole crypto scene and wanted to be able to tell their friends that they had, you know, investments in the space. And so they looked at me as this young, you know, Stanford undergrad, as somebody who probably knew, you know, more about the space. And so, you know, I put together kind of a comprehensive, relatively comprehensive strategy of how I was going to differentiate it between ICOs. I invest all in ICOs, by the way. And how, like, you know, back when I started, at least, there was kind of this idea that you could get 10-year LP cycles for VC, those return levels in like 3 to 5 months. And so that pitch was very compelling for a lot of these, you know, Silicon Valley legacy venture capitalists and investors. And so, and they bought into it. And so, you know, that was pretty much it. And you know, there was some general questions and concerns around, like, you know, obviously the market volatility is the #1 question mark, and so kind of setting expectations is really important. You know, like, you know, obviously that's the point of accredited investor status, is you can still pay the rent if your investment goes to zero. And so, yeah, just letting them know that this is a high-risk investment. It shouldn't be more than a few % of their portfolio. And so I think, all told, that's kind of the key points for me. So.
Well, my experience is a little bit different in that we found initially a lot of people just couldn't understand the opportunity for crypto. So we had to go back to the basics and end up creating a whole boot camp, investor boot camp, to kind of educate them on crypto. Again, the whole issue of, you know, volatility. They go online, you know, on the internet, the news, and they just don't understand the FUD. And you have to always, like, educate them on exactly how to value these cryptocurrencies, you know, how it works, network effects. They don't understand half of it. So we found and these are really savvy investors, but you're introducing them to a whole new asset class, right? And so I think after the whole process of education, you find that, you know, the light goes off, the glimmer. So that's for some. Because of the jurisdiction I'm in, we have, you know, quite a number of high net worth individuals and investors coming in and out. Some of them live there as well. So you have for the older ones, you need that education. For the younger ones, it's just a matter of just better understanding, you know, exactly how the fund works, exactly, you know, what the risks are, and so on, and they make a decision. Again, when you add the terminology impact, then, you know, it takes them to a whole whole different dimension where they start thinking about, philanthropic dollars and doing good and free money, and you have to like pull them back, like, whoa, no, you're talking about assets, and you're talking about a fund that can actually return you, give you high returns. So from that perspective, you then have to educate them on those asset classes, like renewables, and show them how that returns high and so on. So that's been our experience. Then you have the other dimension where you have those investors coming out of, again, crypto is global. So you have investors coming out of Dubai, the UAE. We have a lot of Russians. For them, it's like easy. They understand it. They're like, ooh, insane kits, you got it? I'm coming. So we have different classes. I guess at the end of the day, the best practice is know who you're targeting, understand where they're coming from, and then, of course, segment your market like with anything else and kind of reach them where they are.
Well, I think that's a great point, knowing your investor and really what their pain point is and what you're solving for them. And George, we'd love to hear from you as well.
Yeah, so at HNWI, our LP base is somewhat diversified in that, yes, you have kind of, a lot of us, as I mentioned, have angles in Asia, and so we do a lot of like high net worth or family offices in Asia. A lot of us come from traditional finance backgrounds, so it's a lot of PE, hedge fund guys as well, and then just kind of like networks from our school, like rich friends from USC and Stanford for the most part. But education is key, right? As I think everyone here mentioned, it's a lot of it's you got to go to these guys, give them the crypto 101, tell them kind of like what the strengths of distributed ledger technology are, why the ability to program incentives is game changing, and what the addressable market is, right? A lot of it's level setting the size, kind of it's a very small market with plenty of room to run. A lot of it's saying, hey, if you have like something that could potentially 50x, you have to be kind of 98% conviction that that's not going to happen for you to not put money in, right? So a lot of it's telling them just how to size, because I think a lot of people look at the space and they're almost like think of it as a false dilemma where they treat the option as a binary option where do I put money or do I not put money in? And it's really it's a matter of sizing, right? The reconciler is sizing, because like do you put $1 into the space? The answer is yes. About $2, about $3, and you scale up from there. So a lot of it's talking people through that, and it's educating them on the benefits of diversification, volatility. Yes, it's volatile, but it's non-correlated volatility, so it's true diversification. And the only kind of free lunch in investing is like diversification, right? And so the logical thing to do when you're presented with a free lunch is kind of eat it. And then to your point, like. It depends, right? It depends on who you're pitching to, kind of know your audience. If, I'm going to like an old gray or hair family offices, then a lot of it's kind of, here's how you spell Bitcoin, maybe not that, but like, that's the thing. But if I'm kind of, selling this to my classmates at Stanford Business School, it's a whole different conversation.
So kind of following along those lines, because y'all have talked so much about being so young and starting these funds, and I think it's very daunting for a lot of individuals. And so from an experience standpoint, I want to give everyone a sense of what our backgrounds have been, where we came from before we started our funds, and what I guess difficulties we've encountered along the way with objections when you don't necessarily, at least from George's perspective and Dean's perspective, don't have that experience from a real world, quote unquote, that people look for in investment firms ultimately.
Yeah, so I think actually to level set, right? I think the average fund manager in the space is like 25 or something. So I can speak for myself, but I'm kind of like above average, right, in that regard. But no, you're absolutely right. I think one way to think about it is like a lot of these institutional if you're looking for institutional dollars, a lot of them will require like a 4 or 5 year track record. But the reality is no one has that 4 or 5 year track record, because back then Bitcoin dominance was at like 90, 100%, and you'd kind of just be buying Bitcoin. So kind of like what's the differentiator there? I think there is a little bit of an appeal though that you're kind of young blood. You're a lot. If you come from a traditional background where people kind of respect like the work you've done before, it's an easier sell in that regard because you can pitch, you can talk about things like RR or like how much of your return comes from alpha versus beta to these guys, and they can kind of understand that and appreciate that. But yeah, at the end of the day, it's a hard sell because like you're young guys, and so part of it's they give you smaller dollars. Part of it's like they understand the opportunity. That goes back to education, and part of it's just like for us at least, we get advisors or partners who are older or come from more traditional finance or tech fields that we can put on our marketing materials, bring to meetings, and it's kind of a combination of like, you got the young guys who know the space, running the day-to-day, but they're sort of checks and balances with the older advisors who have been on Wall Street for like 30, 40 years. So I think that's part of it.
Yeah, you're good. I'll just keep the younger fact. I'm not to say. We're all young on this panel, but so I started in January 2017. I was interning at a VC that was invested in the blockchain space in New York, Future Perfect Ventures. It's very small, and Olaf from Polychain was pitching for raising capital. And I heard his pitch, and I was like, I think I can do this. And so I was sort of like made up my mind then that, that this was something that I could do within my skill set, as a finance and computer science undergrad. And so, yeah, I just sort of got that confidence from there. When I started, there wasn't really a framework. Like, I looked at a lot of Polychain's filings. I kind of copied a lot of their stuff, but a lot of it was, just asking dumb questions and figuring it out. Fortunately, there's a little more of a framework now, I think. But yeah, that was my experience.
I think my context would be a little different because I'm female, one, and I'm a woman of color, two. So I'll give you two contexts. Within the emerging market context within which I live, having a track record is fundamental. No one's going to look at you unless you personally have a track record. So I think in our case, my co-founder and I were both women. For me, I have a very long background. I'm like a brand in my space. So been a management consultant for an international management consultant for over 18 years. Started really early, so I'm not going to say how old I am. I'm still very young, yeah. Also a digital economist. My background extends into this whole space of, I did electronic governance focusing on decentralized networks back in Switzerland, way back in 2008, 2007, 2008. So I've been kind of in the space from the beginning, and I've done like so many different global international projects. So with my other firm, I have a track record, and I found for us we were able to start working within the space and developing the ecosystem with this long-term vision by leveraging some of the stuff we've done, with some of our other companies while we're working on Beyond Capital Markets. So within the context, for instance, for the past 4 or 5 years, for me, having that governance background, I know the regulatory environment is very important. So I tackled that from the get-go, started building relationships with the regulators. So I have strategic partnerships with the central bank, Eastern Caribbean Central Bank. We're doing projects focused on education for them. So now they're like open to crypto. They're actually working on doing a digital currency themselves. So you see, building those networks and the relationships are really important and working at that high level. I've also, got partnerships with the World Bank in focusing then on the, supply side, the deal flow. Working on building out that early ecosystem for tech entrepreneurs and doing startup projects. So I have working with them on 3 different projects. So all of that gives the level of credibility that allow us to leverage and pivot, for announcing the fund. You have to do that, I have no choice, or else no one's just gonna look at me. I'm not like you and say, okay, well, I saw someone do it, I'll do it. I also have a finance background, and my co-founder also has an MBA in finance. So we've also been doing quite a bit in terms of the early stage investing space. So yes, in emerging markets, you really have to bring it, and there's like track records of our credibility in terms of what we bring, because at the end of the day, they're looking at you. One thing is against us is we're young. Not even the fact that, we're women. The fact that we're young is like one red flag. And if you're looking at a traditional context where it's really a patriarchal, region, and all they're looking at is the fact that, what can a young person tell me? You really have to be on your A game. So I learned that, through my other different endeavors, that I always have to be the top of my game and always have to bring it while you're being visionary. So that's important. The other thing that we recognize now with the international context is not necessarily the same context. Once you're professional, you bring it, you're more focused on the value proposition. So for us, that's what we focus on, what the value proposition is, It's not as though we're waving our credentials, but really targeting what it is that people need, what it is, the fund can work. And then also, the other thing we recognize too, branding is also important. So we've actually specialized, my co-founder has a background also in brand finance. And so we look at those elements that really make things a little bit more attractive. So you have, a better packaging for us to kind of get the word across. So we're not really dealing with, oh, you're black, or oh, you're a woman, or any of that. I'm a professional. This is what we're offering, and this is what we can solve.
Well, we appreciate that, and Samson, we'd love to hear from you.
Sure. Well, I think the experience required for running a crypto fund is very different. It's completely different, I would say. Right? Because first of all, I totally agree the education piece is so important. It's a totally different asset class, very unique. When we come to stock and equity, they're already very mature valuation models. Right? You can compare apple to apple, different stock. You can look at the earnings and all that, the dividends, the cash flow. It's a very mature model. But when you look at tokens, every token is different, right? It's apple to orange. Everyone have different token economics. So when you're running a portfolio, a fund management of managing such a diverse portfolio with different unique assets, there's a lot of education you need to provide. Not just even the beginning, but on an ongoing basis. For ourselves, you mentioned about fundraising. So we haven't actually done any public fundraising until we have put our private money to run for 1 year, right? We actually put monies from friends and families as a closed pool to run it a year to give the track record before we build it and start recruiting LP, right? Because I think the track record, although it's a new industry, but I mean as of today, is like mid of 2018, it's reasonable to ask for like a year track record. It may not be 2 or 3 years, but 1 year is very reasonable, right? And you also need to know when you're looking at a crypto fund, no matter investor or you try to start one, there's in general three buckets you need to look at, right? There's one is the trading fund. You're really engaging like the Bitcoin trading, the technical trading and all that. And then the second one is arbitration, right? Some funds just focus on the arbitration, how to arbitrate between the 50 exchanges, between all the different pairings. It's a unique, totally different kind of skill, even just for trading and arbitration. The third type, obviously, is the ICO fund. How do you invest in ICO fund? To me, that's most interesting because that's when you get the 100x and 1000x, if you're lucky. But then it goes very deep to token by token. So what's the token economics? You really need to understand the white paper, right? I bet you, like, may I have a survey? Let me know if anyone have ever read through a complete white paper, end to end. Great, we got half here. right? But which is very normal. And let me tell you, like people don't read the white paper, right? And maybe they try, but it's not really easy to fully understand. So
Well, I think that's a very good point. I mean, ultimately, I've seen white paper after white paper that says at any point in time, we can walk away with your money for absolutely no reason. And people invest in them. So can I have a show of hands of anyone who would invest in that if they would have actually read it? Well, yeah, exactly. And that's no, exactly. And that's the concern that you deal with in this economy is how to develop that trust with projects, even understanding that risk is there. So I think that's a great point. And I think along those lines, what I'd like to address next is what's the greatest difficulty or pitfall that you've encountered with starting your crypto fund to this point that you've had to kind of learn from or get over to mature to the point that you're at currently?
okay, I have the mic. I go first. Then.
Finally, you
Okay.
start first. Yes.
Yeah. So I feel now there's still quite a distinguish between like the crypto community and the traditional wealth, right? They're trying to come in, but a lot of the traditional money, they're still watching, trying to learn, trying to figure out why I'm not investing in the equity, but buying this token, it looks like a coupon, you know, right? Why I'm investing in a coupon that I can entitle a service in the future. There's no element linking in the earnings and all that. So there's still whole education process I think now need to go through, right? Running a crypto fund is already better because we provide the convenience, at least the LP don't have to deal with the wallet and all the technical issue, we can manage it for them. But then still, I think for them to cut a check to put in the crypto is still the biggest education hurdles I have seen.
So for me to kind of address the question of like the biggest challenge, I guess, comes from sort of the uncertainty around the instrument that you're purchasing with an ICO, right? So the most common that I've invested in, just percentage-wise, is in SAFs, so Standard Agreement for Future Tokens, basically, which typically have some, like, whatever it is, sometimes as long as 5-year time frame where they can launch the token and actually issue the tokens to be able to trade them and then exit your position with a profit or otherwise. And so what's kind of been an issue is a mismatch between teams, kind of what they communicate to you, what's written and what they actually do. And so it's a lot of times founders of ICO projects are speaking out of both sides of their mouth to core investors and to their community, and the incentives are often not aligned, and that's a big industry issue, honestly. And so just sort of managing that is a real challenge. So like, for example, I reinvested in January and February, like the worst time to do that. But that's just how it worked out. And a lot of the projects that I invested in had promised 6 week, 2-3 months before they were going to issue tokens from the SAFT, and that has been delayed. And so just because you don't want to release into a bear market, there's a lot of money exiting the space. There's good reasons for it. But as an investor, it's frustrating to sort of see these verbal agreements, which are about as good as you can get typically, kind of just go back at a whim, basically, and so you're sort of left helpless. So yeah, I mean, that's just one thing to watch out for with SAFs, is kind of that teams can and will change what they've promised verbally based on their legal right to do so.
I think for us it's two main things. One on the regulation side, and the other one is quality of deal flow. Especially when you're looking at the ICOs, those ICOs, trust. At the end of the day, what I've recognized is because the space has allowed for new entrants, they're totally new. They're new even to the startup space. So I think for us, what we've done is we've created like a whole new rating system that isn't just about ICO ratings, because it's deeper than that. You're dealing with companies. And for the most part, some of them are just not structured right. And some just aren't going to do well. So we spend quite a lot of time in the due diligence aspect of things that go just beyond, the superficial, do you have a white paper or whatever. You really have to look at the company and really look at, I mean, you still have a fine balance between, this disruptive idea and innovation that could really scale somewhere, but also looking at the team, can they really execute it? So that's one of the challenge, deal flow, and really sorting out and sifting through the type of deals that will really create that transformative impact. The other side is the whole navigating this whole global regulatory environment. It's not just your local one. So you spend a lot of times trying to explain to them because, they're listening to what's happening in the U.S., probably they're American. So, of course, in the U.S., you're having this battle between all the different regulators. And they're trying to, within that space, and they're kind of locked out to what's going on in other jurisdictions, other countries. So you spend a lot of time just trying to have them get a better understanding as to how to navigate this regulatory landscape, what you could do from what you can't do. Then you find, because of that, they try and do shortcuts with their token models, the token design, and you realize that here you have something that could be clearly a security, but they're trying to run away from being a security. But you're like, well, why can't you be in a security in another jurisdiction that isn't as, oppressive than be a security in the U.S.? I mean, at the end of the day, you running away from being a security just doesn't make sense. So, okay, so if the SEC is giving you heat, register somewhere else where they have an SEC. It's a much more enabling environment, but then all you're dealing is perhaps dealing with the IRS because, they listed digital assets as assets. So pay your taxes, cool. You could do that in an offshore jurisdiction. So just spending time having them understand how to navigate this. And, because it's maybe they're not familiar with, for example, Nevis or the Caymans or wherever, they're unsure. They listen to a lot of FUD and they're like, are we parking money? Are we hiding? No. I mean, these jurisdictions do have regulators. The regulations were structured to facilitate that kind of business, but you have to do that within the ambit. So, and then trying to do that with a North American lawyer that doesn't have any experience within that space just creates a mess. So you have to also know what sort of expertise or experts you need to help navigate that. So yes, you do need your SEC lawyers and everything to make sure you're balanced, but you also need to also get experts within the different jurisdictions. So for example, we might be in Nevis, but you're going to be trading in Europe. You do need to understand those regulations as well, what you can and what you cannot do. And a lot of times we find these deal flow, they try and cut corners so much that, at the end of the day, even when they're not a scam, they end up looking like a scam. So those are, the key frictions we see.
We appreciate that. And George?
Yeah, no, I definitely echo kind of whatever everyone said here. Sam on education being a heavy lift, and Dean on the SAF stuff. Like I've definitely had one or two SAFs like retraded on me. It's just a function of kind of unprofessional management in the space right now, and obviously the regulatory stuff as well. I think for me, I would say the one challenge that popped out in my mind is just not FOMOing into kind of doing deals. And it's kind of a combination of being a young investor in the space and having LPs who are not used to who want to handhold you a little bit more because like it's a volatile space, it moves really fast, and they're like asking, why aren't you deploying capital? Why aren't you deploying capital? We're on a bull run. But being able to hold conviction and say that we think a correction is coming, we're the guys who have a pulse on the market because we're out there kind of getting intel and running the analysis. We should be able to just say we don't want to deploy capital at this point because we think there's room to fall, and kind of right like you might. I mean nowadays kind of that's pretty. We're sort of in a lower point of the market where our benchmark might be down like 20%, but we're flat, and that's kind of 20 points of like alpha right there. So being able, I guess, to in line with educating the LPs and not kind of maintaining investment discipline when you're looking at and structuring deals is a challenge, but it's a skill that I think we should all develop.
Well, and ultimately, let's go ahead and wrap up with this, because I know we're getting close to the end of our time, and kind of leave off on a positive note, because I know there's a lot of things we've made people wary of. But ultimately, the piece of advice you would give to individuals who are looking to start a crypto fund, what's the one piece of advice that you would pick out for those individuals, whether it's something that's encouraging, something to be aware of, something to be concerned about? What would that be from each of you?
First of all, I would not discount regulation. That is key. That is important. If you are operating, just understand that, like he said, he spent $25,000, and that is rare, okay? Setting up a fund in the U.S. is costly, but you have to also know all the details in setting it up. Back office tends to cost a lot, but if you're moving towards digital and leveraging a lot of digital tools, that lowers your costs quite a bit. Really doing your due diligence, looking for the right lawyers to help set you up in the different jurisdictions is also another thing. We talked about bank accounts. So that whole infrastructure in terms of supporting your bank accounts and so on, you want to have to be aware that a lot of banks do this thing called de-risking. Because you're trading in digital assets, you might be seen as extremely high risk. So you want to make sure when you're setting up, you kind of look and map out globally the different institutions you could work with. And just because you're incorporated in one jurisdiction, it doesn't mean you can't operate in another one. So that's another key factor as well. And here you've seen two from Caymans. They're operating, globally, wherever. You also want to make sure, you have a good grounding in terms of your, I would say your KYC, your customer. I think, with what's going on globally, you can't run away from putting in measures in terms of KYC. Yeah, sometimes people say it reduces a lot of friction, but at the end of the day, if you really want to be serious and you want to actually attract institutional capital, you should really do your due diligence, because any little thing could actually destroy it. And one of the things that's actually big right now is counterterrorism. So investing in digital tools and intelligence tools, I think I saw a presentation yesterday with Bug Labs. Those type of technologies can help you actually do some really good due diligence on a person and individuals in a group, because you don't want 3 years down the line to be caught up in something that will risk you, that will make your whole fund shut down. So that's really key. Of course, doing your due diligence in terms of where you're going to trade and how they're trading. So it's a lot. It could be expensive, but then also look for opportunities and frameworks that you could plug yourself into. The barriers are slowly becoming less for especially in the crypto space. That's why I love innovation. There is a lot of opportunity for you to launch, and there are a lot of new models for you to take into. So also getting education in terms of how to design your fund. There's so many different emerging new models in terms of how you design it, and what offering you can offer is also important as well.
So for me, it's, especially as a inexperienced fund manager, holding your ground in negotiations. So one nature of the business we're in is there's a ton of zero-sum interactions where, either you lose or you win, based on concessions. And so having a thick skin is important, understanding what situations do I excel in, and then when do I need someone else to step in, or with a complementary skill set in terms of a co-founder, or partner, or whatever. And then also just in the structure of the fund, I made the mistake of being a little bit too, I made too many concessions basically in the PPM. allowing for investors to, I only had a 6-month capital commitment. A lot of these sort of concessions that I felt were necessary because of my inexperience, but ultimately kind of cost me just based on timing and lack of, just sort of lack of control on my part. So, yeah, just making sure that you have the temperament to succeed in zero-sum interactions, and but it's been rewarding and ultimately fairly lucrative. So it's a good business. Yeah.
My suggestion is to start looking in the free aspect. First of all, is obviously the compliance issue, how to sort out where you want to set up the jurisdiction, and all the fund admin, fund custodian, all that. And then the second is really think about who is your investors. It would be different if you're starting a fund just for families or friends as compared to really going out to the family office and even more to the institution. The complexity is very different, right? And then at the end, obviously, is also on the portfolio management. As I mentioned earlier, even just a crypto fund, it could do 3 things. It could be a combination of the 3 things. It could be just even a single crypto fund for trading, a separate fund for arbitration, or another fund just for ICO. And of course, it could be a combination. It could be 3 different business. So this is the aspect that you can start considering when putting a fund together.
Well, George, I don't think we got to hear from you, so let's go ahead and pass the mic.
Yeah, I understand. It looks like people are signaling for time here, so I'll be quick. But I think the one piece of advice I would just say is just kind of take your time, right? Know what you're getting into. Take kind of the measure twice, cut once approach. Like line up the right advisors, line up kind of what your strategy is. And yeah, like you have to be in the space for the long term ultimately. And so it doesn't matter if it costs you a couple of months to do more diligence or do things right. Do things right the first time.
I think that's a very good point to leave off on. Again, we want to thank LATOKEN, our hosts here in San Francisco, and for everyone sticking around here late in the day. We hope everyone took away something from how to form a crypto fund, and we hope you all have a wonderful rest of your stay in San Francisco. Cheers.